Hey, what's going on, everybody? Good morning, everybody. Hope everybody had a good weekend. I am joined with James Beech or Jim Beech. He's the president and CEO of Direct Mortgage Corporation. And today we're going to talk about housing affordability. That is always on somebody's all year. That's been on everybody's mind. Realtors, loan officers, home buyers, sellers. And we're really just going to talk about the bullet points. What affordability has done in the last 2.5 years, and really what our government is doing, and really what are some true solutions from people who have the boots on the ground, and what we're seeing to really make housing affordable, and why it's important for everybody to own a home, and kind of the direction that we're going into. I mean, you could agree or not. I think you do agree, Jim, but the direction that we're going as far as renters is just going to leave a lot of people in the dust. So
Yeah.
with that, but thanks for joining me, Jim. I appreciate that. And really quick, just where rates are, we did lose a little bit today in the market. And so, we did tick up a little bit above 6%, but conventional, we're at 6.3%. With that, and I apologize, let me pull this up so I can quote the APRs and not get in trouble by the CFPB. Conventional 6.3%, APR 6.842. FHA 680 FICO with 3.5% down. We're at 6.155 with a APR 7.2, and VA with a 680 FICO 0% down. We are at 5.9% with a APR 6.154. So we're still looking really good. Hopefully, the next CPI report that comes out in November is well for us, and then we can get back into the fives. So with that. All right, Jim. So let's just jump right into it. I know we kind of we talked a little bit about, but let's start off with, I'm going to post this in here, but the government, the Biden administration came out with a report as far as their solution to affordable housing. And we talked a little bit as far as really all it talks about is just creating a lot of renters. Right. It's just focused on multifamily. It's not focused on single family residents or townhouses, whatever you want to call it. They fall in the same bucket, but just how it's focused on just creating renters because it's multifamily, and, I think a lot of the reports that they talk about, housing is so strong, there's all these home buyers and there's so much, people purchasing houses, and we talked about as far as how that is just so skewed and why it's just hurting the homeowners with that.
So yeah, if that's a handoff, I think I want to first of all say thanks for having me on, Nick. You're a good man, and we love the integrity that you have in the business. You've done just phenomenal. So we have a great partnership with you. We know that you send loans to us, and we underwrite those and fund those for you, but your quality is fairly good and your integrity is great, and we appreciate that. So you're trying to do the right thing by the homeowner, and that's really what's important. So what we wanted to focus on was, how do we get the renters to understand that now is not the time, or now is the time? Which one? Is it a good time to buy? Is it a bad time to buy? Mm-hmm. We were talking just before we went live, and that was that the homeowners' equity right now is at an all-time high. So if you own a home, the equity went from, we have a chart that went from 1945, and Nick's showing that on the screen, but we went from 1945, where it was almost down there at zero, very little homeowner equity, to now we're over $30 trillion in homeowner equity. And you almost look at that the end of that spike for the year 2021, 2022, it's almost going straight up and down.
Yeah.
So the homeowner's equity is really important to understand. How do I get that equity? And what you don't get is homeowner equity when the government is building multifamily housing and more people are renting. The people that I'm most concerned about in our market are those that are convinced that now is not the time to buy. And that's not true. Right now is the very best time that it is to buy. Of course, it needs to be within your income limits, but you need to buy a home as quickly as possible. And I would avoid multifamily. I would avoid condos. I would avoid townhomes. You want where the home appreciation is the greatest, and consistently over time, it's in single family homes. It is not in a townhome. It's not in a condo. Now, there's some of you that want to buy a condo. That's fine. townhome, you're still going to get equity, but not like you will with a single family residence.
Yeah.
So anyway, if you have any other comments there, we want to talk about rent maybe next, but you're going to get left behind if you don't jump on that as quickly as possible. And even though home prices are coming down a little bit, even though interest rates are up a little bit, and you never know where they're going to go.
Mm-hmm.
But the best time to buy a home, it was yesterday.
Well, it's any time. The best time, I think a lot of people ask me, Nick, when is the best time to buy a house, right? And I'm like, well, when you're ready to buy a house, right? You have a kid, another kid, right? You get older, the kids leave, you downsize, you upsize, whatever it is, you relocate for a job. Whenever the right time to buy is when you're ready to buy, right? The rates are always going to be the rates. The home prices are always going to be the home prices. You know what? This year lost 10% in equity, but we're still up 10%. So because we had so much equity built up in 2020 and 2021 with that. And, that I think that's the biggest thing. I think a lot of people really struggle with that is I think the biggest pushback that a lot of people that I'm experiencing is they don't realize how expensive housing is, right? And they start looking at numbers, we start looking at interest rate, purchase prices, and then they see that $3,500 payment and they're like, oh my gosh, I don't know if I can afford that, but at the end of the day, if you can qualify, and that's where it's the long-term game and the long-term picture. And I think that's hard for people to conceptualize is that equity that they can build and over time build wealth and then use it going forward.
It's such an important thing. And what most people don't realize is that your income is going to usually increase. Mm-hmm. So sometimes you're looking at a picture and you're saying, well, it's only it looks like what it is today, but it doesn't. What happens with the renter is their house price or their rent payment continues to escalate.
Yeah.
With a homeowner, the price stays the same, but your income increases so that it's more affordable. So that's really helpful. I think it's also really important as you're talking about what's happening with not just the cost of rents. For example, rents, the average renter now pays $1,326 a month.
Yeah.
The average rent asking price now is $1,900. Now you said, so in other words, we're telling you that the rent, and everybody knows instinctively, rent prices are going to continue to go up. They don't go down.
Right.
A house payment never goes up. In fact, if anything, it only goes down because you're going to refinance to a lower rate. Right. So the only time your payment changes is if you go buy a bigger home is really what happens.
Well, and I think because I think the average person is in their mortgage, right? There's difference. You have your mortgage and then you have your house, right?
Yeah.
I think the average person's in their mortgage for 3 to 4 years because the interest rates will be here and they come down. Everybody refinances to a lower rate. You save $150 to $200. Right now, you're able to build more equity because you're paying less interest. 7 to 10 years is the average time somebody stays into a house. They look to either downsize or upsize or whatever have you, And so it's that long game that I think it's really lost in the big media, and that's our big struggle is the big media, the big companies that have the money, and it's really hard because they're the ones getting the information out there. And so us independent small companies are like, look, like there's a better way. Like you could save money, you could build wealth, and that's obviously why I do a lot of the things that I'm doing.
You said one other thing, which was the equity that they have 10% additional equity, but it seems like they've lost 10% equity. Mm-hmm. So just to cover that concept, I think we want to just explore that just a little bit more. Why is now a good time to buy, and why is it that you're still building equity even in today's market when you're hearing that prices are falling? Mm-hmm. So what you're really seeing is, and what we're seeing is two things. We want to talk about what happened in 2008 and that house pricing and the housing crash essentially that happened. And people are thinking that this might be repeated. That's not true. We'll explain that, why it's not going to happen. But the second one is what happens with equity right now. So if people have equity right now, maybe they were going to sell it for 20%, but they only got 10% more. Right. Well, that's still a net gain of 10%. So the government measures this, the Federal Reserve measures it, we measure it. And what you're seeing is that your appreciation, your equity is still, even in today's market, is still growing.
Right.
One or two times over the past 50, 80 years where home prices really went downward, and that was 2008. So we want to talk about what happened then in 2008 and what's different. Today, people have equity in their homes, and they're doing and they can afford their payment. Those two things are a big deal. They have equity and they have payments. So what happened in 2008 is people could do 100% financing on investment properties. And that 100% financing on investment properties went, and stated income means that they couldn't afford the home. And so when the home prices went higher, when their payment went up or when they couldn't afford it, they just walked away from the home. Well,
because everybody was on an arm. I remember my parents were on an arm. I mean, like my parents were on an arm, and I remember that was just, devastating to them, and
so what you had a lot of dishonesty though in the 2008. Your parents were not dishonest, but stated income, the stated value of the property. There's a lot of, and appraisals could be ordered by the borrower or the loan officer. How you valued a property, that was dramatically different. So it's really important to understand when we're talking about equity today, we're talking about equity that is done by a arm's length appraiser. It was not happening in 2008. We're also talking about people have to put real skin in the game. They have to put money in. Mm-hmm. And the third is that they really had to actually qualify for that home. So
right,
there's some legislation that is both bad and good. That Dodd-Frank CFPB that came out of that was bad in some ways because it put a regulatory burden on the smaller guys so heavy that it made it unfair to compete against the larger banks. But what it did do that was good is it made sure that people had skin in the game, that you really could afford the house payment when you're going to sign up for a mortgage.
Right.
And it actually made sure that you actually had money that you actually put in. So you have equity. So that what happened is they did not have equity in 2008. They do have equity today. And people are only going to lower that price so much. So when I'm saying that it's a good time to buy, you are not going to see, because the fundamentals are different, it's highly unlikely that you're ever going to see 2008 repeated because the laws are different, the mechanics are different, the fundamentals are different, mm-hmm. which means that now is the better time to buy. Anyway, I hope that helps.
What's the percentage, and two, the overwhelming majority of loans that are originated or are fixed mortgages? There are some
versus then. So it's literally less than 2% of loans are adjustable rate mortgages.
That's what I wanted to ask. Okay.
Yeah, and in our company, it's actually less than 0.5%. But nationwide, it's less than 2% of loans that are adjustable rate mortgages. You just don't have people that are in a bad situation as long as they're state employed, and if they remain employed, then it's really right now it's the best time to buy.
Yeah. No, that's good. That's good. And I mean, and the big thing too, with the report, I posted it on there, and hopefully you got a chance to peruse through it. But with the governments, we could talk about the feds and what they did in 2020, 2021, and how that has just moved the needle so far away from a lot of people. But then their actions now, it's almost like, all right, let's just pull the Band-Aid off. Let's just get it over with. Like, do what you need to do. You know what I mean? Like, did they need to go as fast as they did? Maybe not, but let's just get it over with. You know what I mean? Let's just go through this recession. Let's right this ship or whatever have you. But then we have the White House coming out with all these incentives to, Department of Transportation, HUD is getting involved, all that. Like, hey, let's just change zoning from single family to multifamily. Let's give incentives to people to build these multifamily structures, but you have to reserve 20% of it to affordable housing, which I am all for affordable housing. I want everybody to be into a house. Obviously, that's my business. But it's almost like, again, going back to the multifamily renting versus owning, it's like, okay, like you're just creating more multifamily. Like, what do we need to do to, one, resolve the supply chain for for single family, material to get those built. And you talked a lot about financing and how, and I read it every once in a while, but you talked about how like smaller banks can do financing, how that's restricted or whatever. Talk about that a little bit as far as the financing that could help single family home ownership, purchasing, and obviously the supply chain restraints that we're facing.
Okay, so the first thing that we want to look at is what is the signs that we want to look for that will help interest rates. And the very first thing is inflation. So you want to look for those signs of inflation. And how do we fix inflation? Well, you can fix inflation two ways: by first of all reducing demand, or secondly by increasing supply. So those are your two ways to fix it and fight inflation and get interest rates to come down. So what you're watching for is, are we producing enough goods right now? Are enough people back employed? Do we have too many people underemployed, or is there enough people employed? When you start to see the factories start to light up and start to produce a lot of goods, that should put pressure on the supply side, which actually sometimes it'll initially make rates go higher, but long term it's going to make them go lower. So if you're looking at what's happening in the marketplace, that's going to bring it down. That's going to bring price down. The second thing that happens, which is what your question was, what happens? How do we reduce the price of homes, and what are the problems with homes? And so one of the things that I am, right, because we do have affordability, can I actually afford my monthly payment? So it has a lot of facets, but the cost of construction is really important. So the cost of materials is, if you break apart the cost of a home, you have materials, you have labor, and you also have then, which is a big one right now, is zoning. You have government fees.
Yeah.
So government, you really can fix that. Now you have local and federal government laws and regulations that have really, in the past 5 years, have gone from bad to like crazy bad. And so you have, it's one thing to say we want to put a park in there. It's quite the other to say, well, we want to charge you for climate change if you're going to buy a new property. And so if we're going to charge you for climate change, all of a sudden, you have your property just went from a $10,000 small plot of land to literally just by government fees went to 40 to 50,000, sometimes higher, sometimes above 100, if you're going into some areas in the country. So and that happens in Utah, it happens in Arizona, it happens in Nevada, it happens in California, especially, of course, in California. But so you have all of these they call them impact fees, and government local zoning laws and impact fees. Those are crazy right now. So that can be really expensive. That's one of the ways. The second one is in the materials in themselves. So if you noticed in 2020, 2021, the cost of a board foot, or let's just say a 4x8 sheet, I think it was at $1,500. It has since come back down to $400. So the cost of materials went high. Well, what caused that to go up? Well, first of all, there wasn't anybody working because of the pandemic. That caused problems. And so what happened is those materials went up a little higher. In fact, they went up a lot higher because not enough was being produced. The second part of that was government intervention, saying, we don't want you cutting down any more trees. We're going to put a limit on how many trees you can cut down. And irregardless if those trees are being replaced or not being replaced. So it was kind of a counterintuitive thing, because everything that I read, they were replacing more forestry than they were pulling out in forestry. And so it was kind of shocking to see that actually took place. So a lot of the regulatory entities also went after housing supplies. So you had the government involved in zoning and impact fees. You had government involved in, and still are quite a bit, in supplies and in the cost of lumber and the cost of building materials. The third element, of course, then you have land. But the third one was labor. It's unique here because I'm not really for just open borders, but I definitely am in for bringing in more people for construction jobs. We need to, make a legal, fast way to bring in immigrants, because that construction industry is being harmed in a huge way right now because the labor costs are so high. So what happened is we had an administration that came in and said, we're not going to bring in immigrants. That kind of shut off the border at the very moment we needed immigrants for housing supply. Right. And I don't like illegal immigrants, so don't get me wrong. I'm not in favor of that at all, but I am in favor of saying, look, we needed more laborers, especially in the housing industry, and that labor cost went skyrocketing because we had fewer people again, it's supply and demand. You had fewer people, so less supply of laborers, costs went up. So those three things were huge in terms of impacting the cost. Do I see that that's changing? Well, yes, we've certainly seen less demand, so that side of the equation has helped. But we'd rather see more supply.
Well, and two, it's like I read an article, Housing Wire article, and everybody was just so plush with cash. It's not like anybody lost their jobs. There are people that lost their jobs, mostly in the service sector, hospitality, restaurants, and stuff like that. But a lot of those higher earners, or say, higher middle class earners, nobody really lost their jobs. They just worked from home, and so people that were making 60, 70, 100,000, 150,000 a year, they were still making that, but they were working remotely. Plus they got all these $600 checks, so everybody was flush with cash, and so it's going out to eat, down payments, closing costs, whatever it is, right? People moving from high cost areas to, say, Arizona. I'm sure Utah experienced the same thing, but gosh, we all kind of joke, like, don't California my Arizona, you know what I mean? And I know a lot of people that are from California, and I love them. They're great people and stuff like that. But we had a lot of people moving from California that were still working remote. And, that's the whole 50,000 above asking and this and that, and so I think it was a perfect storm of a lot of different factors, and I think that's just unfortunately what we went through. And it's just, I think on everybody's mind is, where are we going to go from here? Like, what is 2023? 2022 is the great reset. I'm going to call it right now. I'm going to call it the great reset, not the great recession, the great reset. But what is 2023 and beyond hold for our industry, right? For home buyers, there's still a lot of people out there purchasing.
Well, here's one of the really important questions. Have they fixed the cost of a new home, building a new home? And the answer is no, because government how likely is government going to reduce those zoning and impact fees? Not highly likely. How likely are they to take away some of the regulatory hurdles to produce lumber? Well, they're not very likely to do that either. Yeah. And I think we do have more laborers, but so that helps. But it's only bodes well for people that are homeowners. It's really says, okay, let's turn on that bandwagon.
Well, and I think too, something behind the scenes that we deal with is that actually I'm dealing with it right now is, it's our industry is so big. There's so many different facets of our industry, or I don't know if that's right. Yeah, I guess facets, but just so many different ways that it can operate, right? I'm a broker. I'm an independent broker, right? And then you have you guys as a bank in a sense, right? Because you have your own wire, or your own warehouse line, or whatever have you. You have other brokers out there that can operate as a bank. You have big corporations, Rocket, all that stuff, right? But then you have the builders that have their own lender as well, and so they're making money on the house itself, they're making a large margin on the financing, you know what I mean? And so you already have a very expensive house with a very expensive mortgage, but then they're throwing the money out there, kind of dangling that carrot of like, hey, you want this house, use us, we'll give you this, right?
Home builders right now are in a lot of trouble. They're hurting. They have no idea. They're also behind the curve, so they don't realize how bad business gets, because we're on the front line. They're back 2 or 3 steps from us. So you are seeing some builders put out some incredible incentives because they have to sell. They are in a world of hurt. So I think that also bodes well for just saying it's a good time to go buy. But you can negotiate with these builders. It doesn't matter if you're using their lender or if you're using your own choice of lender. I highly recommend using your own choice of lender. You can still negotiate the same things out of those builders. They're not in a position of strength like they were, a year and 2 years ago. A year ago, they were in a position of strength. Right now, they're not. They're begging, they're pleading, and it's not.
Even sellers, all sellers aren't in a position of strength. You know what I mean? I think I just read an article. It's like 2% of all the homes listed in the last 2 or 3 months. It was from Yahoo Money. They're all getting pulled off the market because they're just sitting. Nobody's purchasing. And so you can come in and ask for that seller credit. So. All right. So, we'll wrap up here. I know you got to get going. So, all right. So interest rates, the last 2 weeks have been well for us. This week is starting off not too hot, but we're okay. Where do we see the Feds have already said that they're going to, depending on the CPI report, maybe they're not going to get as aggressive as far as the rate hikes in December, but they're still going to pencil in potentially a higher Fed rate, where do we kind of see where the Feds are going to go into 2023? Is it true that third quarter, based on the economists from Fannie Freddie, that third quarter we'll see that kind of dip in the rates that we want because we'll get into that recession, then we'll start seeing some different things? What do you project our 2023 to look like?
Well, we're going to see a lot of volatility. Last week was a pretty good example. Wednesday, on a given day, bond prices would go up. If it's really a high volatility, it would be 4 or 5 30 seconds, maybe 6 30 seconds. Wednesday, after the Fed chairman spoke, they call him a little more dovish, meaning he was more willing to say, we're going to slow down the speed of the rate hikes. When that happened, prices went up, which means rates went down. It went 35, 30 seconds. It was gigantic, right? And it was actually negative at the time it took off. It was like a -10, -11, and changed from being a -11 to a +35. The next day it came in, it went down about 18. And these are just gigantic swings. And then you're talking about today. Today's rates are actually lower than they were on Friday. And so you are seeing some volatility. So what I think you're going to see is volatility. You're definitely going to see the Federal Reserve continue to increase them, but not at 0.75%. They went to a half. They probably, the next one is also being baked in at about a half. And they might stop that. I mean, it's getting pretty close to leveling off their prime lending rate. Now, remember, that's not mortgage rates. That's just prime lending. So the prime lending rate. But I see that leveling off. And if we see at the first sign of deflation, or the first sign that inflation's over, in other words, if we get enough supply, if enough people go back to work and are producing enough goods, and we have imports coming in from other countries, that is going to drive that price down. So that CPI number that happens next Tuesday that you're talking about, if that CPI number is high, rates are going to stay high, and you're going to have a reaction next week. If they're lower, you're going to have a reaction, and they're going to go much lower, and that will be mortgage interest rates. So that next Tuesday number is an important number. Watch for that.
Yeah. They continue to watch every month. So with that, all right, Jim, I appreciate everything you guys are doing for me. I really do. It's been a crazy almost 3 years now. And definitely I appreciate everything you do. And I appreciate you taking time to talk with me a little bit about home ownership and, just getting in the market and doing what's best for not only you, but generations to come as far as building that wealth. So,
and thanks for all you're doing.
I
appreciate your support as well. Thank you.
Yeah. Thanks, Jim. Have a good week.
Bye-bye.